MFR, financial checks and audits of those identified as at risk are critical to protecting the industry from financial failures. We can't prevent every insolvency, but we can use data and insights to check whether entities are meeting the minimum financial requirements and to minimise the level of debt incurred. Under changes to the minimum financial requirements that commenced last year, licensees in categories 4 to 7, so that's those with an annual turnover over $30 million, were required to provide their annual financial information or annual reporting by 31 March 2019 to show that they met the MFR. The second tranche of the changes required all contractor grade licensees to provide their annual financial information by 31 December 2019. 31 December is the annual reporting day going forward for most licensees. You can also apply to the QBCC to alter your annual reporting day. These changes to the MFR framework allow the QBCC to monitor how its licensed contractors are tracking financially and whether they have the capital to operate a financially sound business. There's two main things licensees have to do to comply with the MFR. First, lodge the annual reporting information. And secondly, meet the MFR, so that is have sufficient working capital for turnover. There's other obligations, such as notifying the QBCC of an increase of maximum revenue of more than 10% and a decrease in net tangible assets of 30% or a decrease of 20% in your NTA if you're category 4 to 7. Then you have to ensure that you actually meet the MFR with your new revenue or NTA, such as maintaining sufficient assets to cover the turnover that you're actually carrying out. So an MFR report is something that's much more complicated than just annual reporting. So annual reporting is like a snapshot financial health check. An MFR report is a report signed by an independent accountant, and it's only required for specific circumstances, such as when you first apply for a licence, if your NTA decreases by more than 30%, if your max revenue increases by more than 10%, if there's some significant change in your business structure, if you're audited, and some other sort of circumstances that are set out on that slide. In terms of annual reporting, to date, over 76% of licensees have lodged their annual reporting information for that 31 December date. Almost all licensees in categories 2 to 7 have now lodged, which is fantastic. So it's the smaller end of town that are still lagging behind. For licensees who have not lodged their annual reporting information, we first give a notice of proposed licence condition of no new building work. So if you receive a notice like that from us, you must provide your annual reporting information or contact us if you think you've already provided it. If we don't receive the annual reporting information or some contact from you, will proceed to impose a condition of no new building work on your licence. To date, the QBCC has imposed over 300 licence conditions of no new work on licensees in categories 2 to 7. 157 show cause notices have been issued to licensees in those categories, and 6 licences have been suspended for non-lodgement to date for both reporting dates in 2019. Only 3 licences have been cancelled for non-lodgement to date. Where a licensee has lodged their annual reporting information but is not meeting the MFR, we do have a different approach. In late 2019, we published a regulatory guide for the 31 December 2019 annual reporting day. In that guide, we stated that we'd have a different regulatory approach for licensees in categories 4 to 7, so bigger end of town, versus licensees in categories SC1 to category 3, so that's up to the turnover of 30 million. For that second group of licensees, we will give them until 31 December this year to have the required working capital for their turnover. So that's the case unless there's another regulatory breach going on, such as a money's owed complaint or not paying an adjudicated amount, in which case bets are off and we can take action for not meeting MFR as well. For licensees in categories 4 to 7, we take a regulatory action for not meeting MFR, such as a notice to show cause as to why we shouldn't suspend the licence. Now, if you receive a notice to show cause for not meeting MFR, that's your cue to take action. So that gives an opportunity for the licensee to actually meet the MFR before we go and suspend that licence. We can't give an open-ended timeframe, and if compliance is not demonstrated in a reasonable timeframe, then we may take action to suspend the licence until the licensee meets the MFR. To date, we have issued 96 show cause notices and 6 licences have been suspended for not meeting the MFR in categories 4 to 7 in relation to that 31 December 2019 annual reporting day. From the 31 March 2019 reporting day, the QBCC issued 147 show cause notices for failing to meet MFR, suspended 47 licences and cancelled 14. As well as the potentially disastrous consequences for creditors when a licensee becomes insolvent, there's also consequences for those involved in the company that goes under. So directors, secretaries and influential persons for companies will be excluded from positions of influence in construction companies or from holding certain licences themselves for 3 years. The same applies to individual licensees who become bankrupt. Someone who's involved in a second insolvency event for a construction company faces permanent exclusion from the industry.